Thank you for having me. The European real estate debt market is a deep and increasingly sophisticated market, which offers a broad range of opportunities for investors. Nuveen estimates that the real estate borrowing in Europe totals somewhere between 2.9 and 3.3 trillion. Historically, typically in Europe, loans are 5-year loans. They are very often floating rate, but can be fixed rate. They are secured by mortgages. Returns are derived from a combination of the interest rate, the margin, and various fees. Typically 3 different risk profiles. There's a low risk profile, investment grade senior loans. There are mid-risk funds which are investing in whole loans and mezzanine finance, and then typically there are high risk funds which are targeting mid-teens returns and often using leverage in order to achieve that. Nuveen is specifically focused in terms and sees the opportunity in the mid-risk profile. And just finally, to summarise the potential, we've seen in the European market over the last 12 months, interest rates have risen, margins and lending commercial terms have increased for value add and core plus opportunities, and as I said, the banking sector has retrenched. So there is now a very interesting funding gap for the alternative lenders and the asset managers to provide funding into, which provides very attractive risk-adjusted returns and, in reality, very attractive absolute returns relative to those that are available often in equity at this point in the market cycle. Where we are today is that in the interest rate context, there is strong evidence that interest rates should fall over the coming years. The forward interest rates in pretty much every tenor are lower than the current interest rates, which would suggest that the market certainly sees the opportunity for interest rate falls in the coming years. And therefore, there is a scenario now where the market can more readily price opportunities. The result of that is that whilst similarly to the second half of 2022, investment levels have been reduced in the first quarter of 2023, there is certainly signs that investor sentiment is becoming more positive. On the occupier side, actually, the occupier markets across most sectors remain pretty well balanced. We went into the 2022 and particularly into the second half of 2022 with relatively low levels of new construction. So we are in a situation where whilst cap rates have softened a little, we are seeing positive rental growth, and that is definitely supporting the credit case and the movement in values. What does that mean on the lending side? On the lending side, really, the lending market has been obviously following the equity market in terms of transaction volumes, with the exception that inevitably the refinance of loans can't be put off. They have a fixed maturity. So we're seeing a steady flow of both of new financings or refinancings coming to us. So where we are today, we see strong demand from the commercial banks for low leverage lending to the popular sectors such as logistics and the alternatives, including residential. And we're seeing lower demand from the commercial banks for the higher leverage value add transactions where returns are increasing and where we see the optimal opportunity for the asset management. No, certainly there are instances where building owners are selling their buildings and are certainly restructuring their loans. From my perspective, I see it less as a sign of market weakening. and more as a sign of or the necessary market readjustment to what are now considered to be, normal market conditions. I think we would all agree that the incredibly low interest rate environment that we have seen over the recent years has not been historically normal. And we have to go through a period of readjustment in order to be able to take account of normal interest rates. We're seeing relatively few actual loan enforcements, but we are seeing a number of instances of restructurings. Those restructurings are typically, in our experience, shorter term extensions, which are designed, often structured with target achievements in terms of pay downs or asset disposals in order to bring loans back into line with more traditional lower leverage. From our perspective, that is also creating some very interesting opportunities for borrowers who are looking for mezzanine and preferred equity type structures to provide some additional capital that will enable them to create a stabilized long-term financing for the assets that they own. As ever, it's often difficult to categorize assets just by their asset type, and it does come down to the specifics of the individual asset. Generally, what we've seen is performance in the logistics and the housing sectors continues to be strong, whilst cap rates have widened in Europe on those asset classes in the same way as for others. There is strong rental growth still continuing to come through, which is definitely helping with the performance of those asset classes. For offices, it's an interesting point in the market. What we have seen in Europe is a very much a return to the office mentality with office workers. So there is a positive backdrop to that. In terms of retail, we are still very wary of broadly the market, but we are now seeing some very interesting opportunities where values have fallen to such an extent that they are now well positioned for repositioning for the investment capex that is required to give them the next stage in their life cycle. That's the $1 million question. As I said a few moments ago, I think the key drivers is obviously currently inflationary pressures. We are seeing now, certainly in a number of markets, and most markets in Europe, signs that inflation is, if it hasn't peaked, it is coming towards the peak, and obviously that is a key economic element that the central banks are considering in the context of their interest rate policies. I think the biggest sign that I would point to is that the market is determining forward rates at lower rates than today. Whether that means that rates will actually fall, obviously that's it's market dependent over time, but that would suggest that the market is thinking that interest rates are close to their peaks and are likely to fall over the coming months. I would say that the key driver and the key differential of Nuveen is a real estate first approach to underwriting. That approach to underwriting draws on the expertise of our network of offices across Europe, and from a debt perspective, it draws on the specific expertise of the debt team itself, which has been active in the market for many years, and that is obviously critically important to appraising the risk of each individual investment that we are making. people thinking around ESG, we also have to be supported by a paper from our responsible property investment team. We also have, on the construction side, we have our own in-house construction management services team that can help us manage construction transactions. And then critically, in a worst case scenario, should we have to go through an enforcement process, we have the support of our equity teams with the expertise to asset manage the buildings in those circumstances. Thank you for your time.